Your 30s are a great time to start investing, whether you're looking to retire early or build your personal wealth. You'll be more established in your career and have a salary that allows you to save more money. You'll also be young enough to take advantage of compound interest, which can help your investments grow over time. In this video, I'll share 7 strategies for investing your money wisely in your 30s so that you can achieve financial independence sooner. 1. Pay off high-interest debt. While paying off debt is not an investment in the traditional sense, it is a wise financial move. By paying off high-interest debt, you can save money on interest charges and improve your credit score. This can make it easier to qualify for loans and other forms of credit in the future. Of course, you don't have to wait until all your debts are paid off before you start investing. However, it is a good idea to focus on paying off high-interest debt first. Once you have done that, you can start investing more of your money. Before I continue, if you're new here, please hit the subscribe button so you make sure to never miss my weekly videos on wealth creation tips. 2. Invest in cryptocurrencies. Cryptocurrencies are a new and volatile asset class, but they have the potential to be a valuable addition to a balanced portfolio. While they may seem like a fad, the world witnessed in 2017 how quickly their prices can skyrocket. If you are considering investing in cryptocurrencies, it is important to do your research and understand the risks involved. One way to reduce your risk is to invest in trust token stablecoins, which are cryptocurrencies that are backed by fiat currency. This means that they are less volatile than traditional cryptocurrencies and can be a more reliable store of value. Ultimately, the decision of whether or not to invest in cryptocurrencies is a personal one. There is no right or wrong answer, and the best decision for you will depend on your individual circumstances and risk tolerance. 3. Invest in stocks. Stocks may seem risky, but they can be a great way to grow your wealth over the long term. Before you invest in any stock, it is important to do your research and understand the company. This includes understanding the company's financials, its products or services, and its competitive landscape. You can find this information on the company's website, in its financial reports, and in news articles. The stock market is volatile, and the price of stocks can go up and down in the short term. However, if you invest for the long term, you are more likely to see your investment grow in value. Don't put all your eggs in one basket. By diversifying your portfolio, you are spreading your risk and reducing your chances of losing money. You can diversify your portfolio by investing in different industries, different companies, and different asset classes. When the stock market takes a downturn, it is tempting to sell your stocks. However, this is usually the worst thing you can do. If you sell your stocks when the market is down, you are locking in your losses. Instead, you should stay calm and ride out the storm. 4. Invest in bonds. In addition to stocks, you should also consider investing in bonds. Bonds are not as volatile as stocks, and they offer a fixed interest rate. Bonds are like loans to the government or individual companies. Even though they are not guaranteed investments and their rate of return is lower than other investments, they are generally considered to be much safer than stocks. A balanced portfolio should include a mix of stocks and bonds. This will help you to reduce your risk and maximize your returns. 5. Buy a house. Buying a home is not a decision to be taken lightly. It is a complex process that involves a lot of research and planning. However, in markets with reasonable prices, it can be financially advantageous to buy a home instead of renting. This is because you will start building equity in your home, rather than simply paying rent every month. When choosing a neighborhood, it is important to consider the growth potential of the area. You want to choose a neighborhood that is likely to appreciate in value over time. You should also make sure to get a fixed-rate mortgage with a substantial down payment. This will help you avoid paying private mortgage insurance (PMI), which can add to your monthly mortgage payments. 6. Utilize tax-advantaged accounts. These accounts are designed to help you invest for your retirement by making your contributions or earnings exempt from taxes. If your employer offers a 401k plan with a company match, you should prioritize contributing enough to receive the full match. This is because the match is essentially free money, and your contributions will come out of your gross pay rather than your net pay. After you have maximized your 401k match, focus on contributing to a Roth IRA, which will shield you from paying taxes when you cash in the earnings on your account. 7. Invest in a variety of asset classes to reduce your risk. You should also consider making other investments to diversify your portfolio. For example, you could purchase a rental property or invest in real assets like precious metals. There are a few ways that investing in rental property can earn money. Rent payments. This is the most common way that rental property owners make money. Rent payments are typically made on a monthly basis, and they can provide a steady stream of income. Appreciation. Over time, the value of rental property can appreciate. This means that the property can be sold for more than it was originally purchased for. Tax benefits. Rental property owners may be able to deduct certain expenses from their taxes, such as property taxes, mortgage interest, and repairs. Cash flow. Rental property can generate positive cash flow, which means that the income from rent payments is more than the expenses associated with owning the property. Precious metals are scarce, highly valued commodities that have been used for centuries as a store of wealth and a medium of exchange. They are prized for their beauty, rarity, and industrial and investment value. Some of the most well-known precious metals include gold and silver. Gold is a precious metal that is known for its durability, malleability, and conductivity. It is also a store of value that has been used for centuries as a form of currency and a hedge against inflation. There are many ways to invest in gold. You can purchase physical gold coins, bars, or jewelry. You can also buy gold stocks, gold-focused exchange-traded funds ETFs, or gold-focused mutual funds. Silver is a precious metal that is second only to gold in terms of popularity. It is an important industrial metal that is used in a variety of applications, including electrical, electronics, and photography. Silver is also a store of value that is used to make jewelry, silverware, coins, and bars. Silver's dual role as an industrial metal and store of value makes it more volatile than gold. This means that the price of silver can fluctuate more than the price of gold. This volatility can have a big impact on silver stock prices. In some cases, silver prices can outperform gold during periods of high industrial and investor demand. A portfolio with most or all of these investments can help you make the most of your 30s and provide you with a steady stream of income and help you grow your wealth over time. It is important to stay consistent with your investment plan. By making consistent contributions, you will be able to see the fruits of your labor over time. So, those are the 7 strategies for investing in your 30s and reaching financial independence. I hope this video helps you in being one step closer to your financial goals. If you have any questions, please leave them in the comments below. And be sure to subscribe to my channel for more wealth creation tips. I'd see you in the next video. Bye.